Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. There had been here two main patterns on this daily chart that had been driving the market higher longer term. Well, one had been driving the market higher longer term, and one pressing lower in the short term. Both of these patterns are broken with some resultant successful fallout from the subsequent moves lower, but one of them is now looking like it has possibly been repaired. First was a very shallow March to early June bear channel. It's not an ideal pattern, but it did fit in with the recent action just about. It was also below what had been some considerable congestion formed over March and early April between roughly 1170 to 1193. And which is very significant right now as prices are once more, for a second consecutive week, getting wedged within this congestion. This original move lower was prompted by the weekly key reversal down made 9 weeks ago, which formed the peak of a small, if imperfect, head and shoulders top, or even a nascent diamond top pattern. The follow-on lower from this move down reached the targets of both the head and shoulders top and the diamond pattern, making a key break lower 5.5 weeks ago. Not only below the December 2020 low at 1143 even, but more importantly breaking down below the main showrunner for this market since August last year, and that's the dark blue lower time, currently 1168.5 of the second major pattern here, a consistent big picture item, the dark blue December 24 to August 25 bullish Andrews pitchfork. I said on this move lower 6 weeks ago, and I quote, "Now leaves us not only this pattern compromised, but it all opens a way for a test of the long moving average below, currently 1134.5, the first time since the start of January this year, as well as possible tests of the 61.8% absolute Fibonacci line at 1105 3/4, and the pair of 50% Fibonacci lines at 1100 1/4 and 1098 even." End of quote. Since that statement, prices have dropped down to the long moving average, pressing through it, though not far enough through to let go of it completely, and touching and bouncing up and away from the 61.8% absolute Fibonacci line between the 61.8% absolute Fibonacci and December 2020 low at 1143, enough that we formed over June a small double bottom, even Adam type. In early July, prices shot up from this pattern, reaching both primary and secondary targets, and pushing up through the bright green short medium moving average, currently 1170, and the mauve medium moving average, currently 1176. And as far as the previously mentioned congestion between 1170 even to 1193. Additionally, we have further overhead the bright green neckline extension, currently at 1217 1/4. Of December 20 to February 24 head and shoulders top, plus the 50% Fibonacci line of the April 20 to August 24 move at 1222 even, and the December 2021 low nearby, currently at 1223 1/4. Close enough that these last two can be considered one considerable congestion. In addition to these, we also have what I highlighted last week, a bright red early January to late June bullish Andrews pitchfork. Prices are not close to a tie-in right now, but it will be worth noting for the future. We are today in between the bright red lower time below, currently 1129 even, and the overhead bright red middle time, currently at 1261 1/4. Chicago soybean meal. Between January to early June, the market had moved up nicely within the main pattern here. A bull channel formed between the lower and middle tines of the late September to mid-January bullish shift pitchfork. However, 5.5 weeks ago, prices broke down through the lower tine, as well as below the flatlining mauve medium moving average, currently at, where are we? We are at 316.90. Plus the congestion between 309.40 to 311.20, and back then below the slowly rising gold long moving average, currently at 310.60. And even testing below this, the important 50% Fibonacci line of the 25 to 26 move at 302.10, breaching it but not breaking it. I spoke of such a move lower 6 weeks ago when I said, and I quote, below this, well, apart from congestion from January this year between 293.5 to the 50% Fibonacci line at 302.10, well, there's nothing much, and I should say from the overhang on the market since February this year, I could easily see that being tested. End of quote. Thus, this move down from what effectively was a January to early June bull channel left us with some targets below, of a primary target in the 305.20 zone, which was reached, and a secondary hard to reach target down in the 292.90 zone, which was previously threatened, but which I said last week had been placed into likely retirement, which this week has indeed been retired. I said on the move down 2 weeks ago, and I quote, it all depends if prices can punch down and stabilize below the 50% Fibonacci line at 302.10. If we do, watch out for the possibility of a further move lower. The whole late May today action looking like a possible bearish halfway hesitation. Right now it's an open question whether the action over most of June is a hesitation for a move lower or the start of a baiting action. I do know that the longer we stay down here, the greater is the chance of it becoming a baiting action, so watch out. End of quote. Well, my caution was justified as from the start of last week, prices turned higher, pushing up over the gold long moving average, as well as over the interesting dark blue trend line extension, currently at 310.20 to the July to September 2021 descending triangle. However, the rise has been tempered by the bright green short medium moving average and the mauve medium moving average, which is an interesting development. All this has led me to draw a new pattern on my daily chart last week, which is not directly influencing the market right now, but will, I suspect, become more important in the future. It is a bright red mid-January to mid-June bullish Andrews pitchfork, with the market in between the bright red lower time below, currently at 304.90, and the overhead bright red middle time, currently at 328.30. This leads me to my final point, and this commentary would not be complete without my discussing a portion of my commentary which I have repeated now for 163 weeks, so for 3 years now. It is to do with the annual key reversal seen here at the end of 2023. I said back then, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duty came about at the end of 2023 and been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, if there is only one thing you take away from any of my musings, there have been those words. End of quote. For 3 years, the shadow of that pattern has darkened the skyline of this market ever since. I wondered if prices were now finally sending that shadow to oblivion, but once again, it does not seem so, as we are still significantly below the close of 2023. Chicago soybean oil. There is one pattern here that has defined moves higher this year, even when it was being thoroughly tested. It is the bright pink March to August 2025 bullish Andrews pitchfork. The market today in between the bright pink middle time below, currently at 68.58, and the overhead bright pink upper time, currently at 77.46. As well as over the rising mauve medium moving average, currently at 70.14, and the green short medium moving average, currently 72.40. If only just over that latter one recently. The most recent pattern formation here was a turn of May into June horn top, that is part of a mid-April to late June lopsided double top. This latest move lower was prompted by the horn top, negating an earlier weekly key reversal up. The primary target of this double top was reached 4 weeks ago, but the harder to reach secondary target down at 64.85 has not been, and thus with the move up at the start of July, has been retired, much as I threatened last week. Indeed, I noted how the target was at the lower end of congestion dating from March this year, and I was skeptical over the last few weeks of prices reaching down that far. So it was not a total surprise. To see prices rally up since early July, it was not surprised to see them rally up since early July. Now, interestingly, this helps something I've been saying for the past few months when I said, and I quote, I think for this market, the question is not whether the market is bullish or not, but how bullish does the market choose to be, end of quote. This is now the eighth week, and the bullish incentive has indeed seen some heavy dampening, but still not is extinguished. It's still burning fiercely here. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.